Good morning and thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Mathew and with me is Smriti Chaudhary. We'll take you through the next half an hour of trade or so. Now we'll look at the benchmark indices. We've come off quite substantially from the low point of the day, but there's one stock that continues to trade lower, and that is LTI Mindtree. It has posted a disappointing set of Q2 numbers. We're joined by Avinash Goraskshakar of Profitmart Securities as well as Rahul Sharma of Equity 99. Gentlemen, thank you so much for taking the time and speaking to us on NDTV Profit. The objective of the show, of course, is to answer all of your stock-related questions. But before we do that, we'll focus on a couple of these stocks. So first, LTI Mindtree. I'll come to you first, Avinash, on this one. 10% down today. Quite a disappointment. The markets have not seemed to like the numbers at all. What did you make of it? And what should investors that are holding this do? Is there an opportunity, according to you, to accumulate after the dust settles?
I think, Alex, first of all, good morning. And I think as far as LTI Mindtree is concerned, I think numbers were quite disappointing, both on the revenue as well as on the margin front. And I think clearly, I think in terms of the growth on a sequential basis, the performance was more or less flat on the revenue side. On the margin side also, I would believe that, if one were to look at it, I think it would now take at least a couple of quarters before we could see some meaningful recovery. So I think, investors who are holding the stock can continue to hold. It's a decent kind of corporate with a very good order book. But I think execution is going to be the key element. I would not suggest fresh buying even at these levels unless and until we get more clarity on the growth quotient, which is going to happen over the next couple of quarters. So I think investors need to take a slightly longer term call. Those who have invested should at least look at the next 12 to 15 months for a meaningful recovery. I think fresh buying, I would believe that even at these levels, valuations appear to be fair to expensive. So I would prefer to wait for some more time. And obviously, once the March quarter is out, at that point of time, we could take a fresh review. But as of now, it's a hold, no fresh buying recommended.
Right. Good morning, Avinash and Rahul. And we have another stock in focus today, which is Arti Industries, that was up around 8% in the morning, but has since pared those gains and is up 5% in trade. And that, I believe, is on the back of a contract win. And we have Varsha joining us to give us more details on that. Varsha, what's driving the stock higher today?
So, Smriti, as you rightly said, company stock is over 5% today. Now, if you see, this is on the back of company has secured 4-year supply contract with multinational conglomerate. Now, this is to supply a niche specialty chemical, and this deal will generate a revenue of almost 6,000 crores. Also, the company has been supplying this chemical for over past 5 years, and this product is integral part of a company's long-term growth strategy, and volumes have seen a consistent increase over the past 4 to 5 years. And if you see the capex plan for this product, so the ongoing capex program will meet the contract requirements, so no additional capex will be needed for this one.
All right, thank you, Varsha, for that. Avinash, your views on the stock? It's up 5% in trade right now. Would you suggest buying at these levels?
Yeah, I think from a longer term perspective, I think this is the second large order which Arti Industries has got. Earlier, they had got a 3,000 crore order, again, which was a long term contract. This is a 6,000 crore order. So my sense is, definitely if you are looking at the revenue visibility side, it gives a decent amount of comfort for the investor. My sense is that if you have a 12 to 18 month kind of time frame, it seems that chemical prices have stabilized. I think in terms of margins also, we could expect a decent improvement going forward. So yes, from a longer term perspective, I think one can definitely look at accumulating the stock. But in the near term, I would not expect any big upside, considering the fact that these contracts, the revenue flow has to yet begin. And once they start, then they would start contributing to the top line profitability and the cash flow. So I think longer term, yes, if one were to look at 12, 18 months, it's a decent bet in the current scenario. But you need to have a longer time frame to get a decent risk reward.
All right. Thanks, Avinash, for that view on Arti Industries. Let's jump straight to the questions then, and we've got quite a few coming in. Just a quick reminder, if you're tuning in right now, you can send your questions to us on any one of our social media platforms, preferably on YouTube, because we are tuning in on that as well. And we've are available on the chat function and on WhatsApp. You see the number on your screen. You can send us a message on that number. We've got several messages coming in already. By the way, do tell us your name as well as where you're tuning in from. If you bought a stock, tell us what level you bought at. So the first question we're taking is from Jayesh, and Jayesh is asking about Geo Financial Services. He is wondering whether to buy. Let's pull up the stock and see where it's currently trading. He's wondering whether to buy at the current market price. And the question really, Avinash, and sorry, I will come to you on short-term queries, Rahul, but it's seemingly the first few questions are all long-term. Avinash, we don't yet know too much about the business prospects. Of course, some details were made available not too long back. But what do you make of this opportunity? Because that's what it stands at right now, an opportunity.
No, I think, Alex, you're right in saying that, the stock is to be viewed currently as an opportunity, and only the narrative is being played out because, the recent Q3 numbers were quite disappointing. The company did not post very good set of numbers as compared to the second quarter. And I think, the company is in the process of setting up its operations. They have tied up with BlackRock for the AMC business. I think very soon they'll apply to SEBI. My sense is that unless the investor has got a 2 to 3 year kind of time frame, investment in such kind of stocks could yield returns only over a longer period of time. In the short term, quarterly numbers are not going to depict the real earnings potential of the company. But I could tell you one thing, that with a balance sheet size of 1,40,000 crores, they are going to create a massive disruption in the financial services sector. I mean, when the numbers would come in and what could be the impact of those numbers on other comparable larger NBFC players is a thing which all of us would watch out. But I would believe that, yes, if you want to make a decent risk reward and a large kind of moat here, I think the time frame has to be long. So if the investor has invested here, he should rest assured be positive that this company would do well. But yes, over the next, say, 2 to 3 years. In the short term, one should not expect any major fireworks here.
All right. Next up, we have Manish Ranjan writing to us on YouTube. He's talking about HDFC Bank, which has been making headlines since yesterday. And we've talked a lot about it based on the fundamentals and earnings. But Rahul, I'd like to come to you on this. Is it a good time to buy? Is this an opportunity to get into the stock?
Yeah, good morning. See, definitely, I think somehow it looks like an opportunity because the strong support is placed around 1463, and currently the stock is trading at 1500 levels. So the risk to reward ratio becomes good over this current levels. Although the declines we have seen, it will be a long watch to see how HDFC will perform in coming days. But I think 1500 levels is a good level to enter into HDFC. As said by Avinash for the Geo Financial Services, I think here also you won't see any big fireworks coming in. Stock needs to consolidate more at the current levels, and I think going ahead, these levels will be treated as support. 1463 is the ultimate one for the short-term basis. If at all stock breaches these level of 1460, then it might fall towards 1300 levels too. So it's a big watch right now, although the risk to reward ratio is becoming good in respect of buying at current levels.
Got it. All right. We've got a question on Zomato, and this one's from Ankush. He's writing in from Shimla and asking about the stock which he has bought at levels of 50. He's got 1,000 shares. Avinash, this is a long-term question, and ultimately also this is a story I think that is playing out over the long term because behavioral habits have changed and people are ordering more. The question is not necessarily about the prospects, but whether or not this company can make the money and convert that opportunity into profits. So therefore, do you think that someone should hold and buy more at these levels?
I think, first of all, the investor has bought in at a very attractive price. And my sense is that, the margin of safety for that investor is pretty high. See, looking at the business model of Zomato, I think one thing is very clear that the new generation of youngsters, prefer, apps like Swiggy and Zomato. And I think it's now become a daily habit. So I think clearly over the next, say, 2 to 3 years, Alex, one could see profitability kicking in both at the operating level and at the cash flow, at its operationally free cash flow level. Clearly, these kind of platform companies are difficult to build, and you don't find many competitors in this field as of now. So I would say that yes, if the investor has got the next 2 to 3 years in mind, he can make a massive amount of money because this business is going to thrive quite significantly considering the behavioral habits and the food consumption habits in our country. Most importantly, I think now recently we heard that even the platform fees Zomato has increased for most of its vendors. So, that is also going to be clearly a significant moat for Zomato going forward, because clearly this platform is a thriving platform. Many new businesses want to showcase their products on this platform. So I think longer term money will be made. In the short term, it's going to be remaining a range bound. So I think if the investor has a 2 to 3 year call, he can buy on declines and obviously add on to his quantity.
Right. Next up, we have a question from Umapati, and they're talking about Dabur, and they want to buy it for the longer term. Now, we've seen rural consumption weakened, but in the longer term, would you suggest buying Dabur at these levels, Avinash?
See, I think clearly, most of these FMCG companies have a significant moat in terms of their distribution network, in terms of their brands. In the short term, there are going to be some breaks as far as the rural demand goes. My sense is, if the investor again has a long-term view of at least 12 to 18 months, then I think Dabur definitely can fit in the bill. The management has been quite mature. I think they have right products for various, customer categories. But I think in the very near term, if rural demand continues to remain weak, then I think you could expect a weaker set of numbers for the December quarter and possibly for March 24. So I think keeping a long-term view, I think one can look at it, but it's better that we, wait for the Q3 numbers, wait for the management commentary and some key data points on the volume growth number, which the management would share. And then I think one could take a call whether one could make a fresh entry.
Got it. All right. Shivashankar from Bangalore is asking this next question and asking about Tata Technologies and Yes Bank. I will go across to you, Rahul, on the technicals. What would you suggest with regard to these, or rather actually Tata Technologies? I'm not sure if you have enough data, but for Yes Bank, can you tell us?
Yes, definitely. The data for Tata Technologies is really low for me to make any statement here. But yes, Yes Bank is something which has been turned up really well, especially from the lows of around 17.5 rupee. And the breakout we have seen in Yes Bank was made in November month. And since then, the stock has been making higher highs on a continuous basis. I think because of the market scenario, the stock has faced some minor correction from last two sessions. But I think there is a huge support which is placed around 23 levels. So I think along with this, he should keep the stop loss at 23 and carry the trade forward. In coming days, I feel that Yes Bank can be seen over levels of 30. It has a good potential over there.
Okay. I will go across to Avinash on Tata Technologies. The question is whether or not it can be bought at the current level. Avinash, what do you say?
Well, I think, Alex, if the investor has a 2 year kind of time frame, then I think Tata Technologies, which issued shares are roughly about 500 rupees and now trades at 1140, 1150, can definitely be accumulated. See, this is a company which operates in a very niche space and which enjoys a large amount of global clients. And I think the kind of pedigree and the kind of management bandwidth which this company enjoys, I would not be surprised that a lot of value creation can happen over the next 2 years. In the short term, the markets would obviously look at the near term, quarterly earnings, the management commentary. But I think this company has a great future. I think you need to have a lot of patience. And if you have a time frame of at least 18 to 24 months, I think you should accumulate a small quantity. And I think wealth creation would definitely happen. But I think you need to give some more time here.
All right. Gentlemen, we have to slip into a very quick break. Viewers, do stay tuned. We're taking more questions on the other side.
Welcome back. You're watching Ask Profit. Let's quickly jump into the questions. And this one's coming from Ambika. They've bought call options in Hindalco at a strike price of 620 for 5 rupees. And they say, should they exit now? Rahul, what would you suggest?
Well, I think the chart structure is quite low, and I think this momentum will be continued towards the downside. I think 544 is the level to watch on spot, I'm telling. So 544 is the level to watch. If at all it got breached, then I think the stock might fall towards 515 or 510 levels. So I think keep a strict stop loss when at 544, and if at all it gets breaches, then you can see much more declines. So keep 544 on your watch list.
544, okay. Because they're losing money at this stage. All right. So, Ambika, hopefully that is helpful to you. We've got a question on the railway sector, and Natasha is asking about Titagar as well as RVNL and IRFC. Avinash, these are all stocks that have gained, and in fact, not too long back, they gained once again. I guess to a certain extent, there are expectations building ahead of the interim budget. What would you say about the long-term prospects? And these are stocks that are perhaps a little elevated, if you can call it that, on the price side. So would you suggest fresh entries?
No, I think, on the whole, the railway sector, Alex, looks pretty promising because, recently the railway minister, Mr. Vaishnav, has clearly hinted that this is going to be a key focus area for the government, and a lot of cargo which now goes on road transport, the railway is planning to get it back on the railways. So I think, in terms of rolling stock, in terms of the railway stations, in terms of other infrastructure kind of facilities, a lot of capex is going to be invested, and obviously which would benefit, companies like Titagar, companies like, IRFC, which obviously funds the capex of the government. For the railway ministry, I would believe that stocks like Texmaco Rail appear to be quite promising because now it's a question of relative returns. In terms of absolute gains, most of these stocks have almost doubled or trebled in the last 12 to 18 months. So especially in case of stocks like Titagar or stocks like IRFC, I would prefer that unless they correct meaningfully, it's very difficult to make near-term money in these stocks. So I think unless you got a 2 to 3 year kind of vision, it's difficult to make money here. So Texmaco appears to be slightly better positioned as compared to Titagar, which is fair to, premium valued as of now. So I think it's better to, sit on these stocks if you're already invested, but fresh buying can only be advised at lower levels, not at the current prices.
Okay. Next up, we have a question from Mahesh Kumar, and they're talking about this counter Shriji Trans Logistic. Avinash, would you have coverage on this one?
Sorry, I don't cover this.
Okay. This is a 270 crore market cap. They've bought the shares already, and they say that the company is going to give bonus, but it's currently at a low level. Rahul, what would you suggest doing from here on?
Sorry, I'm not able to pull up the charts. I'm not aware of this.
It's called Shriji Trans Logistic.
Okay. So while we try and get your view on that, Rahul, I will go to and the next question. Vineet from Goa is asking about Salasar, and I had pulled up this as well. This is Salasar Techno Engineering, and he's again, this is something that is a play perhaps on the budget, and he's also looking for an outlook on sugar companies like Balrampur Chini. Avinash, anything that you can speak of with regard to the potential of these counters?
No, I think Balrampur Chini, according to me, Alex, is an integrated sugar player. And I think now with ethanol pricing again going up based for grain-based ethanol, I would believe that, companies like Balrampur Chini definitely look promising. But I think you need to stay invested here for the longer term because, currently crude prices are down. I think obviously that means that ethanol is definitely not that very important, although the government has said that by FY25 they will go up to 20% blending. My sense is that you need to take a longer term call. In the short term, the stock may not give you that kind of upside. And which was the other stock, Alex, which you mentioned?
Salasar Techno Engineering. Yeah, I'm right.
Balrampur Chini,
no,
the sugar
So Balrampur Chini was already spoken about by Avinash. Salasar Techno Engineering is the name of the second counter.
Yeah, I think this is a kind of an EPC play, and I think they have a decent order book, but it's a small kind of a market cap company. My sense is, in such kind of small caps, liquidity is a major issue. So unless the investor can brace in for a higher kind of volatile kind of situation going forward, unless that preparedness is there with the investor, only then one can look at investing in this company. I think the numbers have been pretty good, but overall, I would believe that it's always better to play, in the larger cap and in the largely more liquid kind of counters. So I would believe that, unless you have not bought in, if you have already bought in, you can hold on. But fresh buying is not advised because in the current scenario, Alex, the small cap, mid caps have been battered down very badly. So I think it's better to stay put for some time on the, stocks like Salasar, at least if you are thinking of a fresh entry.
All right. Rahul, do you have a view on Shriji Trans Logistics?
Yes, surely. Now I have the charts ready. The stock is facing major declines since the high of around 73, 74 levels, and it has not got any kind of reversal till now. And I think this particular momentum will be continued. Although we can see some like support coming in at the 50 levels, which was made just a few sessions before. So I think if at all it keeps support on 50 and trade above it, I think there might be a chance of some bounce towards 60 and 62. We are able to see there major juncture of moving averages on short-term and long-term basis, but the overall trend is really weak. And I think one should plan out exit at any bounce if it at all gets.
Okay, Rahul, I'm coming back to you on Power Grid Corporation of India. And this is a question coming in from Kishore. He's asking for the next 2 weeks, which is a relatively short time frame. What are the immediate resistances and supports that you would highlight?
Yeah, see, on immediate basis, resistance on Power Grid is placed around 242 levels. Once it is crossed, then there is a good breakout which will form on daily charts. And from there, I think the stock has got good potential to go beyond 250 plus levels. So keep a watch on 242, which are major resistance, which I can see right now. Although on downside, 224 to 225 level is a good support where 89 days waiting moving is also placed. So I think keeping stop loss at 223 will turn up really good for your trade.
All right. This one's from Venkatesan from Coimbatore, and they're talking about ICICI. They bought shares at over 1,000 rupees. It's currently trading below that buy price. They have a view of 1 year. Avinash, would you suggest holding on to this stock?
Well, I think, as far as private banks are concerned, I think we have seen the numbers of HDFC Bank. I think the key challenge for the private sector banks is now the deposit growth. So I think it's better that, the investor waits for Q3 numbers, gets to know what the management commentary is. My sense is that, ICICI Bank is the holding company for various businesses. Like ICICI Pru has put up a disappointing set of numbers, but ICICI Securities has come with a good set of numbers. So the core business growth continues to be solid. But I think what happens on the deposit side, on the disbursement side, I think once we get the Q3 numbers, there would be more clarity. So as of now, I would suggest, the investor to hold on. Please don't make a panic exit. And I think broadly, the story remains pretty strong with a strong corporate capex, with a strong infra kind of spending moved by the government. Private banks should do well. So I would believe that, at least hold on for the next 6 to 12 months. You could definitely get your cost price and a decent risk reward.
Got it. Avinash, thanks so much for that view, and as well as Rahul. Rahul, thank you so much for joining in and answering all the questions that you did. We're completely out of time on this particular edition of Ask Profit. Hopefully, the answers that were given on today's show benefited you, even if your specific question was not answered. We'll be back tomorrow to take even more questions at 11:30 sharp. Don't go anywhere. Lots more coming up over the course of the day, and this is NDTV Profit.
Hello and welcome to NDTV Profit. I am Mahima Vajrajani. Well, Asian Paints is in focus today on the back of their Q3 earnings. We have Mr. Amit Singhal, CEO and MD of Asian Paints, joining us on the show, and he'll be talking about how the quarter has gone by and what's in store for the next coming quarter. Welcome, Mr. Singhal. Well, my first question to you would be that as per analyst estimates, the quarter has given mixed cues. We've seen that profitability and margins have beaten the estimates, whereas for revenue, we've seen that there's a slight miss. What has worked and what has not worked, and has it met your internal expectations exactly?
According to me, I think it's been a relatively good quarter for us in terms of what we have seen highs in every part of the business to that extent. We have seen the overall volume growths on a double digit, which I think is quite spectacular in terms of the delivery. Even if you look at the value growths net of the price decrease in terms of what we have taken, they would come to a level of about 7 to 8% overall to that extent. So we feel that from an overall revenue point of view, I think it's been a very good performance, especially what we saw in Q2 to that extent. Second, from the point of view of overall margins, we are now at one of the highest gross margins in terms of what we see. Even the PBDIT margins have gone by 400 to 500 BPS points. So I think it's been a very, very strong quarter where we have seen growths, double-digit growths, even in terms of our industrial sales, which has been also a hallmark other than the decorative sales. The projects business has also kind of done quite well to that extent. So even in the home decor business, we have seen an overall trajectory in terms of doing well in terms of newer categories. So on the whole, I would say it's been a fairly good quarter for us.
Right. And to pick up on the gross margins that you talked about, it's like you mentioned, it's been best in the past 11 quarters now. And taking crude prices into consideration and your procurement or hedging strategy that you have, do you think this will continue in the next coming quarters? And if yes, how much improvement do you find in the margins?
See, I would say that in a way, the gross margins have literally peaked in terms of our overall assessment. Going forward, while there was deflation in quarter three to about 0.2, 0.3%, we expect further deflation to continue in Q4 as well to that extent. But given the fact that today there has been a little bit of a volatility with respect to overall crude prices, with respect to the geopolitical situation, we see that possibly it is very difficult to estimate in terms of saying that whether the gross margins can go up or not. But in our opinion, I think the band of 42 to 44 would kind of continue from a point of view of overall gross margins as I see it. We also see increased possibly spending with respect to overall areas of marketing, distribution, and new initiatives in terms of what are going to kind of come in overall to that extent. And therefore, we feel that I think it's reasonable to expect that possibly this band of margins, of gross margins, should be maintained in quarter four.
Right. So as you rightly mentioned that you plan to spend higher in terms of marketing and ad costs, can you just tell me how much percentage of this ad cost forms of your sales?
So overall, in terms of the marketing expenses vary from about 3 to 4%, depending on in terms of how the environment is to that extent. And as we look at possibly there is, depending on how the markets go, we can look at possibly putting more monies in terms of the overall spends. But I think the whole scenario pans out in terms of looking at the overall cost and not only in the marketing cost, because even the way you kind of distribute material, the way you kind of look at discounting the market, all form a combination in terms of the overall strategy.
Right. Also, we do see that there's some kind of gap between volume and value growth. What is the reason for the same? And do you think that there's some kind of strategy that you're going to adopt to improve your product mix?
In fact, we see that in quarter three, the product mix has actually improved relative to quarter two. We see the luxury products growing at a double-digit kind of a framework to that extent. And In Q3, we have seen that the T3, T4 cities have done quite well overall to that extent, which has given a blip to the economy products overall to that extent. And you are seeing a little bit of a increase with respect to the value and volume gap, which has kind of come into that extent. But as I said that today going forward, there is a large economy segment in the country today, which contributes sizably to the overall paint market. And therefore, it is always essential to kind of see that you are growing in that sector if you want to overall log in good growths as we kind of go ahead. Despite that, the company has been looking at premiumization as a big strategy where we are upgrading people to premium and luxury products going forward. But as we see it, I think this gap between volume and value of about 3 to 4% would continue for some time as we kind of go ahead, because the overall contributions of the premium and the luxury sector are not so strong in terms of looking at saying that they can basically take the value much higher than the volume as we kind of go ahead.
Right. Also coming to your segmental performance, we saw that home decorative, industrial paints and your white teak business has also performed well. However, if you see your bath fittings segment, it has declined. Can you tell me what is the reason for the same? And do you see the contribution from this segment increasing in the coming quarters?
So overall, as you rightly said, that the home decor sector has done fairly well for us. We are now the number one integrated home decor players in the market in terms of where we are. The new categories have done exceptionally well, whether it is lighting, doors and windows, fabric, furnishing, and so on and so forth. The kitchen business has been a little bit flat, but much better than what we saw in Q1 and Q2. The bath business has been negative, but lesser negative, I would say, as compared to what we have seen in the first half of the year to that extent. So we are now under the new strategy, integrating kitchen and bath very strongly with our beautiful home strategy. And we feel that this is the right step in terms of looking at this integration coming. And as we kind of go forward, we think we will be able to galvanize kitchen and bath along with the newer categories to give us a good contribution as we go forward. We are looking at now, the home decor category contributing to at least about 8% by the end of financial year 26.
Okay. And Amit, with respect to Grasim venturing into the paint business, do you think that this will pose some kind of competition to Asian Paints? And do you think that Asian Paints or any sort of peers in terms of paints, you'll be losing any kind of market share to them?
So overall, if you look at the construct of the overall industry, new competition has always been there. You yourself know that there are a lot of new players who have entered in the last about 5 years also. Last year, we saw an entry of 3 new players in the market to that extent. And even, the company which you're mentioning has launched in one of the segments in terms of already there in the market to that extent. I do not think that given the construct of the industry of being of about 80,000 crores, that we see that any new player can really come and change the dynamics of the market so easily. In this industry, to even kind of log in a growth of 5,000 crores in 3 years is a real wonder in terms of what I see, what could really happen. And therefore, I feel that, in the short to medium term, I am not seeing any larger changes happening in the market in terms of the entry of any new competition.
Okay. And we've also seen that you've infused approximately 33 crores of equity share capital in Asian White Cement Holding Limited. And I believe that is a part of your backward integration expansion plan. Can you tell us what's the status of that? Do you still expect it to be completed by December 25? And also your integration with VAM, what is the status for that?
So overall, when we look at the cement project is definitely on time, and we see that we should be able to complete it by December 25 in terms of the way it is going. Overall, from the point of view of VAM-VAE project, also directionally, I think, and in terms of overall areas, what we are working, it seems to be that the project should be on time, and we should kind of see its fruition in another 2.5 years, definitely.
Okay, and in terms of capacity, you've increased your total, capacity in your 2 different plants. What is your total capacity at present? Where does it stand? And what is the utilization levels of that capacity?
So currently, with the newer expansions, we've expanded the capacity by almost about 2 lakh KL in terms of our overall capacity, going ahead of earlier, which was close to about 17 lakh KL to that extent. This is apart from the capacities which we utilize outside in our processing centers overall, and is almost to the level of about 70-75% overall in terms of what we are doing.
Okay, and I believe that in this financial year, you forecasted 4,000 crore of capex. What is the status of that? Have you fully utilized it? And going forward in the next coming year, what are your capex plans?
So I think overall we have announced a capex of about 9,000 crores in the next 3 years in terms of what we are doing. We have already utilized about 2,000 crores of capex in terms of the current year overall as we look at by March. And as we go ahead, I think we are still looking that we should be able to spend closer to the number of 9,000 which we have given or 8,500 which we have given over the last 3 years.
Okay. Right. Okay. And what is the rural market outlook that you're looking for? We've seen that rural market volumes from rural market have improved this quarter. So what do you think, urban or rural? What will be the driving factor for the coming quarters?
I would say both, because we are equally dependent from our point of view of growth on both the factors. The good point is that in Q3 we have seen the T3, T4 cities mushrooming back to that extent and contributing in terms of the overall numbers to that extent, and therefore I think the hopes are good as the harvesting season approaches to that extent and the agrarian demand picks up. Overall, we do hope that both urban centers and the rural centers should kind of really grow as what we have seen in Q3, and I think that would be definitely defining the overall growth for the coming quarters.
Okay, and my last question to you would be, what is the outlook for FY24 and 25 in terms of both top line and bottom line?
So as it is, I think it is too early to kind of talk of the FY25. I think at best we are looking at in terms of the Q4, which is coming up, where we definitely feel that the double-digit volume growth trajectory should continue. And we would possibly look at how Q4 goes, and then looking at certain other factors which are happening in the country to see what would be possibly the growth of overall financial year 25.
All right. So you expect that the double-digit volume growth will continue in the coming quarter. That's a good sign. That's a healthy sign. Thank you so much, Amit, for speaking with us at NDTV Profit and sparing your valuable time.
Thank you so much.
Thank you so much.
and welcome to NDTV Profit. Joining us today is Mr. Debashish Chatterjee. He is the CEO of LTI Mindtree. He's speaking to us a day after the company declared its third quarter earnings, where revenue inched up by 1.2% quarter on quarter to about 9,016 crore. But there was a dip in the margin by about 60 basis points. Mr. Chatterjee, welcome to NDTV Profit.
Good morning, and thank you for having me on your show.
Thank you, sir. The pleasure is all ours. Let's start with how the year started for you. You had targeted double-digit growth at the start of the year. Where do you stand now? What is the picture that you can give us for the next quarter, as well as some cues about FY25?
So, as far as the year is concerned, we must say that this is unprecedented times where maybe it is the macro and the cautiousness among client environment coming out of the pandemic, where there was a lot of spend, clients becoming cautious about their spend, looking at ROIs of the spend that they have done during the pandemic. Keeping all these things in mind, I don't think we have seen this kind of caution in client environment for the last 4 to 5 quarters. And, we were quite positive that, growth will happen, but that's why we called out very early at the beginning of the quarter that we don't anticipate that growth. Having said that, we have also gone through the integration process. So there was a time taken to ensure that two companies of similar size coming together, and we have unified capabilities, all aligned to the go-to-market strategy. So all these things also took some time. But what has happened in the last quarter is we never anticipated the kind of furloughs that we have seen in Q3. We normally have furloughs in Q3, which is normal. We even expected above average furloughs. But what has happened now is we have seen furloughs much deeper into the industry segments like BFS, where we normally have furloughs. But not only that, we have also seen furloughs coming in those verticals or those industries where traditionally we never used to see furloughs, like energy and utility, for example. So the furloughs have definitely been, a dampener, and the delayed decision making that we have been talking about in the last 2 quarters as well, that continues. There are many deals that we have closed, but there are a lot of other deals that we are, almost at the final stage of closure, which are just getting shifted to the next quarter. So hopefully we should be able to announce some of those things as we go along. So essentially, it's the furloughs and the delayed decision making which has kind of impacted the Q3. Now, getting into Q4, it's very clear that most of the some majority of the furloughs should start coming back, but they will come back gradually. It is not that they will come back in one shot. So that also means that the uptake that we expected will take a little bit of time. So keeping that in mind, we called out our overall how the revenues will shape up in terms of Q4. And from a longer term perspective, if you look at the margin program that we had set aside as a part of the merger integration, we had very clearly said that we will be taking the margin up. We were on that journey, and I think the plan still remains intact as because margin is not a 1 quarter phenomenon. It's a discipline. It's a program that you lay out, and that program is pretty much on track. All that we are saying is, given the fact that our utilization is so high, given the fact that we have closed so many deals which require ramp up, we have to reinvest back into the business. So rather than chasing the margin, or rather, we are just trying to not halt the margin program, but just defer it by a few quarters so that we can focus on the growth as and when the markets open up, as and when the deals ramp up. We want to ensure that we can invest in terms of the growth. And then again, the margin program will fall back on track after a few quarters.
Okay. Since you mentioned about margins, the EBIT margin took about a 60 basis points hit in Q3. You mentioned furloughs was the reason. Just what I wanted to ask, will you be able to achieve your 17 to 18% EBIT margin for FY24? What margin levers are still in play for that thing to be achieved?
No, we have very clearly called out that for FY 24, we are not going to, we are that 17 to 18% range does not hold good. So we are going to, but at the same time, the plan remains intact, but we are just deferring it by a few quarters. But when you talk about the EBIT bridge, just to clarify, we lost almost 200 basis points because of furloughs, fewer working days, and quite a bit of seasonal pass-throughs that we have in our business in Q3. But we recovered 80 basis points from our SG&A efficiency, as well as 60 basis points from our other operating efficiencies. So we lost 200, got back 140. That's why you see a decline of 60 in terms of our EBIT.
Time for a quick break. On the other side, we'll continue our conversation with LTI Mindtree's Debashish Chatterjee about the company's outlook for the coming quarters. Stay tuned. Welcome back. We are still with LTI Mindtree's Debashish Chatterjee. This was your highest ever inflows at about $1.5 billion. That is about 15% quarter-on-quarter growth. But revenue is up marginally. So clearly the conversion is still not happening. So can you give us a picture about how the discretionary spending is shaping up? Are you seeing some green shoots going forward?
Discretionary is down. I think discretionary is definitely one of the primary challenges that we have faced as an organization, because if you look at the overall profile of our revenues, it has been heavily dependent on the discretionary spend of the clients. We knew 2-3 quarters back, that's why we have been focusing in terms of the larger or rather multi-year cost takeout deals. Now, what you need to appreciate is that this, the cost takeout or the efficiency deals, it takes much more time to mature because the decision cycle is longer, and on top of that, they are getting delayed as well. But the good news is that once the deal gets signed, it's almost like a multi-year deal. So you have an opportunity to get a steady revenue over a period of time. But it takes time to ramp up as well, because there could be potential transition also involved in those deals. So keeping all these things in mind, at a broad level, discretionary has come down, so that the projects are down, but more of cost takeout deals going on. The ramp-ups have started. So the $1.5 billion order flow, we are really excited about it, but we also know that it will take some time for us to get those fully ramped up. So that's why the revenue, which will kick in, will take some time.
Okay. Final couple of questions to you, sir. You aspire to become a $10 billion company within the next 4-5 years. Where do you stand on that target now? Is there some revision? Will you push back that target a bit?
Well, if I'm pushing back my overall plans by a couple of quarters, and if the revenue has been not in line with our expectation, obviously the plans will be pushed out by a few quarters. But I can assure you that as an organization, we have enough things going on. We still feel that, as and when the market opens up, we are in a position to capture the market opportunity better than anybody else. And we have also got, a lot of plans of doing, inorganic at some point of time. There are conversations. We are always looking at opportunities. So when you talk about the $10 billion plan, that has got, both organic as well as inorganic components. And, that plan doesn't, that plan doesn't get changed. Maybe it gets shifted by a few quarters because of the current macro and the headwinds. But that doesn't mean that we are changing any of the plans.
Got it. Final question to you, sir. Your president, Mr. Sudhir Chaturvedi, spoke with us in the previous quarter, and he said that LTIMindtree is seen as the best alternative to top-tier players. We are a breath of fresh air, as what he had described LTIMindtree. Will you agree with that assessment still? Are you still scoring above your peers?
Absolutely. I mean, whenever there's an opportunity in terms of consolidation, I think I can't tell you more details, but in the last quarter, I have been personally involved in a couple of opportunities where we have competed with tier ones and won them. I think what my colleague had mentioned is when you talk about LTIMindtree, we are still, we have become larger. We want to maintain the same level of agility and nimbleness with which we, support our clients. And that's what is important at this point of time. The capabilities that we have is exactly what the clients are looking for in terms of the future, developments, etc. So in all respects, we are well positioned. But the macro environment has been overbearing at this point of time.
All right. Thank you so much, Mr. Chatterjee, for speaking with us today, and all the best for Q4 and the year ahead.
Thank you so much.
Hello and welcome to NDTV Profit. You're watching The Portfolio Manager, and my guest today is Gurmeet Chadda, who is the Managing Partner and CIO at Complete Circle PMS. Gurmeet, thank you very much for joining us on NDTV Profit. Let's start with the investment thesis that you have. You have two kind of portfolios. One is a core portfolio and the other is satellite portfolio. Take us through the investment thesis for the core portfolio.
Yeah, thank you. Thank you for having me. The portfolio is one. We basically divide the portfolio into two parts, which is core and satellite. At the heart of the metric is, our basic philosophy is growth at reasonable price. We are still largely growth investors, but not at any price. By core portfolio, we mean businesses we want to own for a long period of time. Here, the focus is on ownership of business, where we want to hold the stock for 5, 10, maybe longer years if the investment thesis stands. And here we try to make few times and not just chase 10, 50% return. So I would like to hold some of the names for longer periods of, let's say, 10, 15 years to probably make 10, 15 times over it over a very long period, rather than just be happy with 10, 15%. We follow 3 financial filters here, and then there are quality filters. The first financial filter is that the top line should double in 3 to 4 years, which means we are chasing 18, 20% growth. So a lot of the MNCs, some of the PSUs may not make the cut, which generally are good companies, but may not be good from our filter point of view. Any growth in top line should not be at the cost of margins. So margin should be expanding. So let's say, for example, you have Maruti, which used to sell probably 7 lakh cars in 2015. They said they'll end up probably selling 18 lakh units. But the margins have dropped as market has moved from sedan to UVs. Their margins have come to single digits or double digits. So hasn't really resulted in much, let's say, capital appreciation. So are some of the pharma names and so many others, where top line has happened, but margins have been shrinking, hasn't led to any shareholder gain. So any top line growth has to be accompanied by margin expansion. And for the both of two, for sales to grow and margins to grow, the heart of the core DNA has to be innovation. So you should be continuously innovating, and that reflects in the value add you do to the product and services. So again, taking another example, same example, let's say the largest OEMs and supplier of the auto, which is Uno Minda, their kit value per car has gone up from, let's say, 3,000-4,000 rupees to 26,000-27,000 rupees over the last 6-7 years. And it's been more than a 10-bagger. In the same space where auto has gone through slightly rough patch. So the core DNA has to be innovation. This innovation could be in terms of technology, in terms of new products you use, in terms of new processes, backward integration, molecules you develop. So it could be across sectors and not just confined to tech or manufacturing alone. So the core portfolio, and then obviously you have the return ratios to work. This essentially is 80-85%. Part of the portfolio, which we want to hold for a very long period.
So how many stocks would be there in that core portfolio of yours?
Between 14 to 17 stocks, would be, maybe 18 stocks would be part of the core portfolio, which we want to hold for longer period of time.
So when you say that your key themes are BFSI, auto, manufacturing, consumption, and IT, take us through some of the companies or portfolio companies where you see that kind of 10x baggers which are going to come in, because you're going to invest in it but not going to exit for another 10 years. So how are you going to look at it?
So our top themes, so we work on this philosophy is to invest what you know more. I'm essentially a banker. So obviously I like BFSI more, financials more. And we're not restricting here only to banks and NBFCs. We want to play the complete space, which includes private banks, includes NBFCs, include capital market participants, which is, let's say, depositories, RTA agents, exchanges, AMCs, insurance names, right? So it includes other financials as well. So just to give you a few indicators, for example, if you see mortgage to GDP in India is about 11%. That's about 20% for Thailand and about 35% for Malaysia. I'm not even getting into the developed nations. So huge market. The entire mortgage market is just 50 lakh crores, of which 13 lakh crores is between SBI and HDFC. So you'll probably need, more institutions and maybe another HDFC, SBI maybe a dozen more to increase this mortgage penetrations to maybe 25-30% as we go along this decade.
So do you find SBI and HDFC Bank a 10-bagger?
I can't say that everything could be a 10-bagger in this space, but they'll be very steady in this space. But some of the capital market participants, the depositories, the AMCs, the RTAs could be in that 5-10-bagger range. Some of them have already delivered probably that kind of return in last 2 years. But if you take a more longish view, also pretty soon. Look at, for example, the MF total. We just crossed 50 lakh crores. The FD base is 200 lakh crores. So a lot of the growth is very, very structural and secular in this space. So we play through private banks, we play through some of the PSUs, as you rightly said, and through depositories, exchanges, and others.
And in the auto space, you are mainly playing through the allied sector, or is it going to be the OEMs which you're looking at? Because OEMs go through ups and downs in terms of margin based on how various factors impact them.
So, if you see, it's again through the entire, we play the entire value chain. So we like PVs more, which is passenger vehicle car more. Again, if you see now, the trend is towards UVs and SUVs. So 2/3 of the cars sold are SUVs. And if you see again the ownership, so number of cars in India, the total cars right now, which meets the safety norms, is about 35 million. This number itself will grow. You'll reach a stage where probably the number of 4-wheelers and 2-wheelers sold will be same 6-7 years from now. So we like M&M and Tata Motors. Tata Motors have been we've been very lucky there. M&M also to a large extent still trades at about 15 times. Then we like as you said, the entire value chain of it. The Uno Mindas, the Sona BLW, the Sandhar Technologies of the world, the KPITs of the world, which are into CASE, which is connected autonomous shared electric, which is the embedded software part of the car. So you want to play that complete chain. In fact, we are of the opinion that this sector has come out after a 4 or 5 year lull. We have very good 4 or 5 years ahead. As far as playing this entire value chain is concerned. And again, we are seeing premiumization here. So that adds to the margin, the second parameter we spoke about, which is expanding margin.
Let's talk about the satellite portfolio of yours, because it's interesting that there the time frame is much lower for you, and whatever profits you earn from there, you plow back into the core portfolio. So how does that work? What kind of how do you select stock for the satellite portfolio?
So just to just spending 30 seconds more on core. So it's BFSI, it's auto, manufacturing. Manufacturing also covers auto to an extent. The fourth one, which we like, is consumption, and premiumization of consumption, which we are seeing, whether it is hotels, whether it is the likes of Tata Consumer, whether it is, the travel Indians are doing. So entire thing comes under that. Satellite portfolio is more tactical. That's basically a special situation portfolio. We want to take advantage of any corporate actions like demerger, change of promoter, any change in regulation which has happened, which can be a tailwind for the sector. So I'll give you an example. Sundaram Clayton got split into 3. You got an auto ancillary, you got the holding company, which is TVS Holdings, and you got a preference share, which was giving you a dividend at around 10%. This happened when the stock was about $4,000. The stock has doubled in last 1 year. Obviously, some of it is because of market. The Sundaram Clayton stock has got listed, which is the ancillary part of it, which now is at about 1,500-1,600, and the preference share is due to mature in Feb. So, just by playing that story, you would have made very handsome returns. Another example is the change of ownership, change of promoter. So one company we bought was Mukund Steel, where Bajaj acquired almost 72% stake from the Shah family. They infused capital, sold a piece of land, almost 1,500 crores came in. The stock was available at about $100 at about 1,100 crore market cap. So it was a no-brainer. Was available at 4 times earnings, and steel was going through an upcycle. So you had the others trading at 15-20 times, and this was available at very low single digit. So we played that. It again has doubled. So some of these examples are there. We went overweight on Reliance because we wanted to have a pie of Geo Financial. So tactically we went in there. So that satellite part for us, where the view is confined to the special situation playing out, and any money made is then, as I said, is plowed back into the core.
Will you consider Geo Financial as a multi-bagger to be held for 10 years?
I would think so, because they would be incubating more businesses, which includes broking, which includes insurance, which includes AMC. This could be something, I mean, I'm not trying to draw any parallels here, but it's something what probably Bajaj Finserv did in the last decade. And with the kind of team they have, they're Ritesh, Mr. Kamath is there as the director. They're stitching together a very, very good team, but it's long drawn. The lending book takes time to build. The insurance and AMC business have very long gestation period. So I agree with you. You've got to have a probably long issue, which is fine.
Plus, there has been some headwinds in the sector.
Sorry, I didn't get
I
the
said
point.
there has been some headwinds in the sector for in the NBFC sector for lending, retail lending and unsecured lending.
No, it's not headwinds. It's just that the regulator wants to be a little more prudent, considering the past experience we have had. RBI data shows some stress in small ticket loans, especially, which is less than 50,000. But the quality ones, which are like, let's say, Chola or Bajaj or some of the better names, I don't think so they have any reason to.
Typically, what is the timeline for these satellite portfolios that you have?
As I said, the situation playing out, it could vary from 12 to 24 months, maybe a little more. Some of the stories I mentioned just now probably played out within 9 to 12 months. So happy taking some money off there. It also helps you maintain some dry powder for any volatility in the market, because the satellite portfolio would never be more than 15-20% of the portfolio. So it also helps you, especially when markets are trading at where they are, it makes sense to have some dry powder also in the portfolio.
What is the normal level of dry powder that you normally keep?
Yeah, our mandate is not really to be in cash, because when the client gives you money, it's meant for equity. But as I said, we at these levels, because the markets are run up quite a bit, about 5 to 10% cash is something. It's not a huge cash call we are taking, but that's more for any opportunities which may come, for any volatility in the market. And also, I would also say there is some pockets have become very expensive, especially small micro caps, some of the capex, some of the railway, and some of the defense related names. So we want to buy them. It's just that the price is not to our liking. So it helps you probably stay on the sidelines. And mind you, staying on the sidelines also earns you 7-8%. That's what even the fixed income rates are pretty decent these days. So it doesn't hurt you too much.
Gurmeet, hang on there. We'll come back after a short break and discuss this pocket where we're seeing some kind of overvaluation coming in and getting expensive. Stay tuned to the portfolio manager. You're watching NDTV Profit. Welcome back. You're watching The Portfolio Manager on NDTV Profit, and with me is Gurmeet Chadda, who is the Managing Partner and CIO of Complete Circle PMS. Gurmeet, before the break, you spoke about the fact that there's some sections of the market which is now becoming overheated, or I would say rather than overvalued. Some pockets of small caps. You spoke about defense, and you also spoke about railways coming in. Take us through the small cap pack, because we have seen a big outperformance happening in the small cap and the mid cap sector. How do you see this sector now at this point in time?
So it won't be wise to just paint the entire sector with the same brush that everything is expensive. But yeah, large pockets are expensive. If you see the small cap index, it trades at 26 times earnings, right? Let's say Nifty 21 times, which is, I'm talking one year forward. Last 1 year return for Nifty is 18 and a half. Small cap index is more than 50% up. And we've seen that in the past, that over long periods, which is, let's say, 8-10 years, the difference is just 1 or 2% between all these indices. And if you remember December 2017, we had a very stellar rally in small cap. In 2018, we saw 20-30% correction without Nifty really having much correction. So the nature of the space is